usual housekeeping items. I will be on with you all today as well as Rachel Hawley. So if you have any questions, throw that into the Q&A portion and we'll make sure those are answered either in the session or prior or after. There are materials attached, so please take a moment and download those as well. For CPE today, we will need a total of 3 polls replied to. So as they come up through the session, take a moment and complete those polls. I'll also give a reminder when we do launch that. If you're joining us via browser, make sure you're set to full screen as those polls can be hidden in the window. You could expect the certificate within 5 to 10 business days at the most. That'll come from the sender certificates at conferences.io. I say that because sometimes it gets hung up in spam, so keep an eye on that. So for this session, we're welcoming back Nick Bava and Jim Savio. Nick, an audit principal with us, is responsible for providing technical services to Sikich's government clients in all areas of governmental accounting, auditing, financial reporting, budget development, internal controls, revenue and expenditure forecasting, as well as cash and debt management. Jim Savio, a principal with us, is responsible for providing technical services to Sikich's governmental clients in all areas of governmental accounting, auditing, financial reporting, etc. So without further ado, I will hand it over to our facilitators for today.
All right. Thank you, Rachel. Thank you to everyone for taking time out of your day to join us for today's session. We're really excited to have you as always. Hopefully you've been joining us on a continuing basis as part of our Yellowbook series, but if this is your first time with us, welcome. We hope you all enjoy the content and exciting material that Jim and I have for you today. So as Rachel mentioned, we're bringing to you our 10th session of 2025, and that topic centers around capital assets. So we'll be getting into some of the basics about capital asset accounting, highlighting some good sound capital asset policies to consider, as well as covering some of the new GASB standards that I'd say certainly have impacted probably most folks here joining us today. So we do have lots to cover, and we're gonna dive straight on in. So let's start simple here and get into the definition of a capital asset. So capital asset is an asset used in operations with an initial useful life greater than 1 year. And this definition includes both tangible and intangible assets. So what's the difference, right, between tangible and intangible assets? A tangible asset could include things like land, buildings, building improvements, vehicles, machinery, equipment, infrastructure. We'll certainly dig into the specifics on infrastructure here in a little bit. Intangible assets, those could include items like easements, software, water rights, mineral rights, and probably the more applicable out of anything from intangible assets are those brought to you by our newest GASB standards, those on leases, software subscriptions, PPPs. Now, a capitalization threshold determines which assets qualify or maybe don't qualify to be reported in your financial statements. And when you do capitalize an asset, you'll want to consider really all the relative costs that are required to place that asset into service. So in other words, the cost to acquire, construct, improve, or otherwise place an asset into usable service. So I'd say overall, this is really a good working definition and kind of baseline for capital assets as we dive further in here to today's presentation. Okay, so infrastructure assets first were defined, and we're going to get historical here, back in the 1968 in the Gaffer Blue Book. So from a definition perspective, infrastructure is defined as long-lived capital assets that are normally stationary in nature and normally can be preserved for significantly greater number of years than most other capital assets. Examples of this would include roads, bridges, tunnels, drainage systems, water and sewer systems, dams, and lighting systems. Now, pre-GASB 34, it was optional for organizations to capitalize and report infrastructure. And I'd say as a result, many governments prior to the implementation of Statement 34 didn't capitalize infrastructure. So in 2001, when GASB 34 came into play, it took away that optional reporting of infrastructure assets and began requiring capital assets to include those infrastructures, either retroactively or prospectively based on the size of your government and which phase of the Statement 34 implementation you were included in. So just to refresh folks on that and the requirements of Statement 34, if you were a phase 1 organization, that would be revenue greater than 100 million. If you're a phase 2 organization, that would be revenue between 10 million and 100 million. And then lastly, if you were a phase 3 organization, it'd be revenue less than 10 million. So depending on your organization, phase 1 and phase 2 organizations had to retroactively report infrastructure assets, while phase 3 governments could elect to report infrastructure prospectively. So that was the differentiator there when you did have to implement, back 20, 25 some odd years ago. So let's look at the definition of intangible assets. An intangible asset is an asset that possesses these 3 characteristics. The first one being lack of physical substance. So an asset may be, say, closely associated with another item that has a physical substance, say land, for example, but an intangible element to that could be the case of a right-of-way easement. Another component would be non-financial nature. So an asset with a non-financial nature is one that is not monetary in a monetary form, similar to that of cash and investments. And it also doesn't represent a claim or right to assets in a monetary form. And then third and finally, it has an initial useful life extending beyond a single reporting period. Now the definition, yes.
Sorry to cut you off. It looks like we're having some glitching from your video. If you want to turn off your video so then it can help your bandwidth a little bit.
Sure.
Okay, sorry about that. Thank you.
Is that better? Is the audio okay?
Yeah.
Yeah.
You're looking good.
Perfect.
Thank you.
Okay. So for the definition and scope of Statement 51, this applies to all intangible assets except for assets that meet the definition that we just covered, but are acquired or created primarily for the purpose of directly obtaining an income or a profit. And in those situations, that's when GASB Statement 72 would give us the guidance and classify, those assets as investments. Additionally, assets resulting from lease transactions, which as we know are now addressed through GASB Statement 87. Also assets resulting from subscription-based IT transactions, which are now addressed through Statement 96. And goodwill created through the combination of a government or another entity, which we don't really see as commonly in this space. So you've heard me mention a couple times already leases and Statement 87. So these next few slides will quickly hit on some of the key pronouncements that have certainly impacted capital asset accounting and reporting over the last few years. First one here is GASB Statement 87, specifically on leases. This now requires the recognition of certain assets and liabilities, right, for leases. This got rid of the distinction between what was an operating lease and what was a capital lease, with the ultimate goal of establishing kind of a singular model for lease accounting based on what GASB determined as the foundational principle that leases are financings of the right to use an underlying asset. So that's leases. Jim is kind enough to devote his part of the presentation today to get into the more specific details of 87 and all the fun that came along with that standard. Next one here, GASB Statement 94, also potentially resulting in intangible assets, although I'd say it's not very typical in what we see with most of our local government clients. This standard was required to implement over 2 years ago. So the primary objective of this standard covers public-private and public-public partnerships. Those are referred to as PPPs. An example of this type of arrangement, could be when a government, say they contract with an operator, and that operator could be another government or it could be a private entity, and it's that contracts to provide public services by conveying control of the right to operate or use a financial asset. Typically, in most cases, that asset's going to be something along the lines of infrastructure or another capital asset. Now, additionally, this standard provides guidance on accounting for availability payment arrangements, also known as APAs, which is when a government compensates an operator for services that may include designing, constructing, financing, maintaining or operating an underlying non-financial asset for a specified period of time. So again, I'd say overall, there's not tons of applicability in the local government space from what we've seen, but again, if this does, potentially trigger an agreement or contract with your organization, consider this, as this is certainly an intangible asset possibility for your organization. Lastly here, GASB Statement 96, I'd say really is the sister standard to lease accounting from Statement 87. Again, this was also applicable over 2 years ago. I feel like going through these slides, we all might be getting PTSD from revisiting these, these fun, complex standards that we had to go through, in such a short period of time. So I apologize for that, but very high level, this standard provides guidance on accounting and reporting for subscription-based IT arrangements. In other words, software subscriptions where your organization has the right to use another party's IT software. So Jim will certainly be getting into the details of Statement 96, along with a few other accounting pronouncements. Okay, so a good working capital asset policy, in my opinion, is critical to your government for maintaining proper controls over capital assets. All governments should have a capital asset policy developed by staff and ultimately approved by your organization's governing board. So with that, what are some of the critical components that you want to include or consider in your capital asset policy? A few things here. First, define the types of capital assets that are covered in the policy. You may even want to consider separating policies for certain types of assets of governmental activities, because those differentiate from assets of business type activities, like utilities, for example. I'd say most policies in the past definitely have focused on capital assets that your government owns. I just mentioned a few standards that are results of capital assets that your organization does not truly own. So it's important to maybe redefine what types of assets that are included in this policy to make sure that those intangible items do get within the scope of your policy. One of the more critical components to the policy is what is the threshold that your government uses to capitalize assets. I'd say we tend to see thresholds vary from one organization to the next. I would say there's probably more of a trend these days that we're seeing more governments increase their capitalization threshold for a few reasons. One, to help reduce the administrative burden of capitalizing and tracking assets. And additionally, as I'm sure folks are all aware, we've seen a pretty large increase in inflation and the overall cost of items over the last few years. So, increasing that threshold certainly aligns, with those 2 points. Additionally, it's important to consider and establish different thresholds for different classes of assets, right? So you have, for example, typically we see you would capitalize, the threshold for land would be $0. Maybe for equipment, you would have $25,000. For buildings, you have $50,000, and then $100,000 for infrastructure. And then simply put, any potential asset that falls below those set thresholds, you would not capitalize and you would just expense. So continuing down the path here of a capitalization policy, you'll want to develop it with classes of capital assets and focus on reporting requirements that how they're displayed on the face of your financial statements and in the notes to your financial statements. So, knowing that, you'll want to separate classes of assets by depreciable versus non-depreciable, and don't forget to include that term amortization, accumulated amortization, and amortization, right, to capture those intangible assets through leases and software. For estimated useful lives, typically this should be established by asset class as well. And for depreciation methods, most depreciation methods we see are plain vanilla, that straight line depreciation method. I don't think I've seen double declining balance method really with any of my local government clients. Reporting capital assets, maybe you need to separate your policy by governmental activities and business type activities. As I mentioned earlier, the same policy for your assets of your governmental activities may not work for that of a water fund or a golf course fund. And lastly here, from a responsibility for custody perspective, I'd say this is probably the missing piece that we usually see in policies, but it's also a pretty critical component. Like procedures for disposal, for example, Most common issue we see is that organizations keep capitalizing but don't remove old assets that were replaced. We see that especially with roads, water sewer lines. Second one here is frequency of inventory. How often should this occur, and for what asset classes? Is it annually, maybe biannually? I'd say it's probably not necessary for buildings and larger assets, but certainly may be applicable for your organization's equipment. And then required interdepartmental reporting. And this could cover additions, disposals, transfers. Certainly the larger your organization is and the more decentralized your organization is, this is pretty key to be able to have clean and clear communication across departments to ensure that you have accurate capital asset reporting. Some other items that could be included are capital assets acquired through non-traditional means. Sometimes these, may have the potential to fall through cracks. Examples like this could include annexation agreements. Is your organization annexing existing infrastructure, which maybe then becomes your infrastructure? Or were you subject to a jurisdictional transfer with another government? Sometimes we see, transfer of assets from one organization to the next. Government takeovers, consolidations, combinations, those are certainly possible, not overly common. We've seen a little bit of this in some chatter as far as E911 entities are concerned. And then lastly, based on threshold, many capital assets, will not be capitalized, but you'd still want to consider including them in an inventory listing, right? Whether that be for insurance purposes or just simple custody purposes. Now, a change in capitalization policy, specifically the change in a government's capitalization threshold, was actually recently addressed in GASB's newest implementation guide. I think that guide is 2025-1, and that states that a change in capitalization threshold is the application of materiality to a specific asset class, not an accounting principle. Therefore, the requirements of Statement 100 for a change in accounting principle, including required to have to restate those balances, do not apply to that change. So I've got that question from a couple clients as they've considered changing their capitalization threshold. So you can certainly point to that implementation guidance there. But as always, review GASB 100 for the most current guidance on reporting these accounting changes. Talk to your auditors. Make sure you have a plan if you do go through something, as large, in scope as change in capitalization threshold. Now, for recording the acquisition of a capital asset, purchased, leased, or constructed assets are recorded as an expenditure in governmental funds when acquired, and at the inception of a lease or as constructed, and then they're capitalized in governmental activities. But again, we never do that in a governmental fund. Contributed assets, say maybe a developer contributed an asset as part of a developer agreement. You would value that developer contribution at acquisition value. It's essentially the same as fair value, just it's called differently as part of GASB Statement 72. Now, purchased, leased, or constructed capital assets that are capitalized in proprietary funds when acquired at the inception of a lease or as constructed, most budget for that outlay. So, you may want to use a contra expense account to capitalize and maintain, consistency and comparability on your P&L. And then lastly, contributed assets are reported as revenue in proprietary funds, and that revenue, for the time being, before GASB Statement 103, will be classified as capital grants and contributions. So when is capitalization not required? This is not required for older infrastructure acquired prior to July 1st of 1980. So the GASB 34 phase 1 and phase 2 implementers had to go back a ways to capitalize infrastructure, while phase 3 implementers, as we mentioned earlier, were able to prospectively capitalize as part of their implementation. So what else might not be required? Collections of art, historical treasures, not overly common. Last one here, certainly, based on your organization's policy, individually immaterial items, may fall below those thresholds and wouldn't be capitalized as well. So when is depreciation or amortization generally not required? This would be for those capital assets with indefinite useful lives. Most common examples are land and construction in progress. GASB 34 did exempt infrastructure assets from depreciation or amortization if you use the modified approach. Modified approach, I'd say, is very uncommon in what we see with our local government clients, but just calling that out here today. Last bullet point here is certainly very common with what we see, construction in progress. You do not start recording depreciation until an asset is placed into service. So you do start depreciating when that asset becomes functional and can be used by your organization. So what happens when a capital asset is associated with more than one government? Question would be, who records the asset on their financial statements? There's a few things that you can look at to help determine that answer. I would say the main thing here is ownership, really is the decisive criteria in terms of proper reporting of that asset. Typically, legal title is going to be the sufficient, point to establish ownership. If you can't readily determine, legal title or ownership, you can then look at, who's the responsible organization for managing and maintaining the asset, with that being the last resort for concluding on the appropriate, reporting conclusion there for that particular asset. And it's always, again, important to make sure that for these types of assets in question, you want to make sure they're not being reported by multiple governments. Now, major asset classes must be displayed on the face of the financial statements or in the notes to the financial statements with changes by asset class and accumulated depreciation by asset class as well in the footnotes. GASB 87 and 96 do require separate reporting of intangible assets, and most recently Statement 104 has provided guidance on how to report and classify these items, and this is something Jim will touch on here in a bit. So what are some of the typical asset classes that we see on a consistent basis? And remember, governmental activities certainly can be different from business type activities, but first things first, we have land, right? This is always separate. You would include all costs that will have an indefinite useful life in that land addition. Those could include things like excavation, grading. Land, as we know, is not depreciated. Next, we have construction in progress. This is also not depreciated until the asset becomes serviceable and usable by your organization. We have buildings. You can certainly have subclasses of buildings too, and any costs that come later that increase the service utility of the building or extend its useful life, you would include those as well. And as we all know, we do depreciate buildings. Improvements other than buildings, these typically have useful lives less than the buildings themselves. Items like these could be parking lots, maybe HVAC systems. You would also depreciate building improvements. For furnishings and equipment, what we call movable items, you would depreciate those as well. For infrastructure that is separate from land and buildings, normally these are reported, sometimes as networks or subsystems. As we know, we depreciate those. And then lastly, leased assets or subscription assets are intangible and classified now through these new standards. Those are amortized. All right, so we made our way to our first polling question of the day.
Yes, so how many leases applied within your organization related to GASB 87? So as a reminder, this is required for CPE credit. I'll give a little bit, but right now it looks 1 to 5. We're at 91%. Okay. I will close the poll, and it looks like 1 to 5 is our area.
Is our winner? All right, not too bad, but enough to have to go through the fun of implementing, right? Okay, so moving on here, what do we include as capitalizable costs for our assets? So kind of going down the list here, acquisition costs first. These would be simply the cost to purchase or construct the asset. Second bullet point here, any ancillary charges. These would be costs necessary to place the asset into its intended location and condition for use. Things like professional services, engineering services. We typically see those included, but again, with these types of costs, I'd say make sure that your policy clearly defines and allows those to be included in the value of that asset. Now, interest is no longer capitalized. That was eliminated through statement number 89, so that's a small win there. And then lastly, application of internal resources, those would be direct and indirect. So how do we determine the capitalizable cost for internally generated intangible assets? I would say this is fairly uncommon in our space and requires, that all of the 4 criteria below must be met. I'll save us the time. We got a lot to cover here, but these 4 bullet points all must be met in order to qualify. GASB 51 did make it a pretty high bar to clear to make sure that, a bona fide, usable, internally generated intangible capital asset exists at your organization. Now, again, fairly uncommon here. Usually only large governments, such as states, tend to develop their own software. So we won't get too much into the weeds on this, but what this slide does tell us is what stage and the related activities, with those stages are capitalizable. So key takeaways here, there are 3 stages of software development, and only costs from the 2nd stage here may be capitalized. And again, this only applies to internally created computer software. So one common question we get pretty often is, what is an improvement to be capitalized versus what is a repair that should be expensed? Now, improvements that increase an asset service capacity or extends an asset's useful life generally would result in capitalizing the cost of that improvement, right? Now, contrast that with, maintenance and repairs. Maintenance and repairs preserve an asset's service capacity or useful life, but it doesn't expand or extend those. So maintenance and repairs are and should be expensed when they're incurred as opposed to capitalized. Now, road surfacing is probably the most applicable with those points. Some of our clients take the approach that resurfacing, where the top layer of asphalt is removed, is repair and maintenance, as it only preserves the service capacity, while others maybe would treat it as a capital asset. I would say that, complete road replacement where you go down to the sublayer is considered a replacement and would truly meet the definition of a capital asset. Again, I'll reinforce this. Ensure your policy defines what is a repair and maintenance that will be expensed versus what is an improvement or a betterment that should be capitalized. And just ensure that you're applying that consistently across all of your capital assets. So valuation, I would say, is a pretty debated topic related to capital assets. Unlike the private sector, some of your assets go back hundreds of years, and valuing those assets can certainly be challenging. I'd say the primary principle we have today is what we use the historical cost to account for capital assets. And if historical cost is not available, then we use some estimate of historical cost, and we can use a standard costing methodology where we determine the cost of a comparable asset in the same time frame and use that as an estimate. I'd say what we see most common is normal costing, where the current or replacement cost of that asset is determined in today's dollar, and then we backtrend that using some form of an index to estimate that historical cost when it was acquired. And as I mentioned before, donated capital assets, say infrastructure put in by a developer, those are reported at acquisition value. Basically, this is the estimated fair value. We just don't call it the fair value. So we discussed depreciation briefly when talking about those capital asset policies. We generally depreciate assets unless we use the modified approach under Statement 34. But again, I don't think I've worked with any organizations that use the modified approach, so very uncommon. Definition of depreciation. Depreciation is the method of allocating the cost of using a capital asset over the capital asset's useful life. Question is, do we depreciate all assets? No, right? We talked about land and CIP not being depreciable. So there are certainly a few methods of depreciation, but we also want to first think about when do we start depreciating an asset? Maybe do you give a full year of depreciation when an asset becomes serviceable? Do you use half a year? Do you go no depreciation? Either way, clearly define that in your policies so you can apply that consistently. Now for the methods of depreciation, most common method is straight line, right? We see that 99.9% of the time. That's where you allocate the same amount of depreciation each year over the estimated useful life. There are other options. One is the activity method, where you would allocate an amount of expense proportionate to the service value that is exhausted for that period. So say if have a car within your organization, you could depreciate that car based on the mileage used per year of that car. I'd say that sounds like a lot of work. Last option here, allocating increasingly smaller amounts of expense over time to compensate for increased maintenance on older assets. So the declining charge method. But as I said earlier, straight line is certainly used most commonly in practice and is very straightforward. So whatever you choose, just ensure it's documented and applied consistently in your policies. Now, estimating useful lives is also a key component, right, in our industry and in our policies. Other factors to consider when going through, establishing a useful life. Think about the asset's quality, asset's application, the environment in which the asset will be used, the government's maintenance and replacement policies, what experiences has the government had with similar assets. Now, salvage value is the asset's residual value at the end of its useful life. Most governments, I would say, assume this to be zero, but if you do estimate a salvage value, that will affect the calculation of your depreciation expense. And then the last bullet point here, you also may depreciate assets individually or similar assets as a group. If a group depreciation is used, I would just say ensure that items in the group have the same useful life and were generally, acquired around the same acquisition date. All right, so we've made our way to our second polling question.
Yes. So how many wins does your fantasy football team have so far this season?
I don't want to answer this one.
I'll shout myself and my colleague Tom Sawicki out. We are currently 6-0 in our Sikich league. So yeah,
nice.
I think it's time to start taking it easy on our on our coworkers here. Just kidding. No, I think we really want to win. But yes.
All right. Well, I'll close it up. It looks like majority of us do not participate in a fantasy league. That includes me.
12%.
Well, thanks, Rachel.
Yeah.
Great. Thanks, Rachel. I will take over and take us the rest of the way. I've got a lot of stuff to cover, so I will dive right in. The first topic I'm going to discuss is GASB Statement 83 related to asset retirement obligations. So this came out probably about 6 years ago. I think the effective date was 6/30/19. So it's been out for a little bit now. I think it had limited impact, at least here in Illinois. We did note that water wells do have a retirement obligation. Those are material for most clients. The other one that probably applies everywhere would be underground fuel storage retirement obligations. We found that in that instance, though, most of the time it wasn't material. The cost was usually, I think, $25,000, $30,000. So wasn't considered material. Most people didn't record that, but most municipalities that had a water supply with wells, typically you'd have 4 or 5 or more. It was material, so that was recorded as an asset retirement obligation. You can see it's basically a legally enforceable liability associated with the retirement of a tangible capital asset, and retirement is the permanent removal of that asset. You can go to the next slide now. So the initial recognition for the ARO, you're going to want to record a liability when it's been incurred and then it's reasonably estimable. So it has to be able to be estimated before you can record it, obviously. So incurrence is manifested by both external and internal obligating events. So the external obligating event is going to be a federal, state, or local law or regulation. Could be a legally binding contract, or it could be a court judgment. And then the internally obligating event is going to be in the instance of a contamination-related ARO. It's going to be when the contamination occurs. Otherwise, it's basically whenever that whenever that asset's placed in service, because you want to recognize that obligation, that liability, you want to recognize that expense over the entire life of that particular capital asset. So you record the liability to a credit. Debit is going to be the deferred outflow of resources, and that's going to equal the ARO liability. And then subsequently, for the liability, you're going to want to adjust it for inflation or deflation if it's material, and then annually reevaluate basically how you measure the liability and the estimated outlays, and see if anything significant has changed with that. And then on the outflow side, you're going to record an expense in a systematic and rational manner over the useful life of the capital asset. If it's been abandoned, then you recognize everything immediately and just write off that liability. You can go to the next slide. Some of the disclosures, if you're legally required to provide funding and assurance, you want to disclose that. If you've got assets that are set aside that are restricted for paying that obligation, you don't want to offset that with the ARO. And the cost to comply with funding and assurance provisions are basically period costs. So you're just going to record those in the period that they're incurred. And then you can see the disclosures here, general description of the ARO and the associated capital asset, why it's an ARO. So like I said before, some law or regulation, a contract, a court judgment, methods and assumptions used to measure the ARO liability, and then the remaining useful life of the tangible capital asset. Those are going to be the main ones that you're going to record. If any of the next three are applicable, you want to disclose that as well. How the financial assurance requirements are being met, any assets that are set aside to pay the liability, and then if you've incurred the ARO but you can't estimate what the amount is, you also want to disclose that and the reasons why you can't estimate it. So that's GASB 83. Like I said, the applicability, basically it's going to be related to utility operations. So water, sewer, electric. Special districts may have some AROs related to pools, site restoration. And you're going to want to work with your public works facility managers, as well as your attorney to determine the legal requirements. So this is one that's not super applicable to a lot of people, but it's also one that can kind of slip through the cracks. You may not consider asset retirement obligations. So it's just something you want to be aware of on a go-forward basis. And I'm having PTSD, as Nick said, looking at this slide. So I think we've all had a lot of fun with GASB Statement 87 related to leases over the last, it's been about 3 years now. So we have gone through it. Probably most of you have implemented it, and you may even have had some remeasurements so far. So you can see the what, why, and the when here. I'm not going to go too far into this. I will point out FASB and IASB had similar projects at the same time. I think FASB's was 842. So they basically had similar projects as well as GASB. So the lease definitions in the first bullet point, a contract that conveys control of the right to use another entity's non-financial asset for a period of time in an exchange or exchange-like transaction. So the key points there is control of the right to use, which we'll discuss in a second here. And then it has to be an exchange or exchange-like transaction. So it's somewhat common in governments to have a lease that may have like $1 a year fee or something similar. So that's not an exchange or exchange-like transaction because you're not exchanging like value. So those would be excluded. So it's got to be an exchange or exchange-like transaction. So the right to use asset is specified in the contract, and then control is manifested by the right to obtain the present service capacity from the underlying asset, and then the right to determine the nature and manner of use. So that basically what control is. You can go to the next slide. So initial reporting. So for the lessee, you're going to record an intangible lease asset, the right to use that asset. It's going to be basically the value of the lease liability plus prepayments, and then any initial direct costs that are ancillary to the placement of to place the asset in use. Liability is going to be the present value of the future lease payments, including any fixed payments, variable payments based on an index or rate, variable payments that are fixed in nature, and then certain residual guarantees. So in most instances, the liability will equal the asset, but there's a chance that the asset may be more than the liability that you record. And then on the lessor side, you're going to book that lease receivable, which is for the most part would equal the liability for the lessee. And then you're going to continue to report your leased assets. So you still record the activity for the leased asset, record depreciation, and everything else. So you continue to do that like you always would. And then the other side of the lease receivable is going to be a credit to a deferred inflow. So it's going to be the lease receivable plus any cash received up front that relates to a future period. So deferred inflow usually equals the asset, but there's a chance that it may be greater than the asset. And then subsequent reporting. For the lessee, you're going to amortize the asset over the shorter of the useful life for the lease term. And then on the liability side, you're going to reduce it for the payments that you're making, less the amount that's related to interest expense. And then on the lessor side, you're going to continue to depreciate that leased asset like you always have. The one exception is if it's an indefinite useful life. So if you're leasing land, or if they have to return the asset in the same condition or enhanced condition, then you may not depreciate it. And then you reduce the receivable for the lease payments that you receive, less amounts that are recorded as accrued interest income. And then on the deferred inflow, you're going to recognize that over the lease term in a systematic and rational manner, usually just straight line basis over the lease term. So that's 87. Went through it not in as much depth as we will 96 because it's been out for about 3 years, like I said. Statement 96 for SPIDAs has been out about 2 years, about 2 years now. So we've kind of implemented this and then gone through a second year for most people. So you can see the what, why, and when there. Basically, there was really no guidance related to software licenses or SPIDAs. So that's a main reason, plus some conflicts with GASB 87 related to leases. I would say too, for the typical client for 96 related 87, I think there were a lot more of them probably, but I think a lot of them were scoped out due to most of them being short-term in nature. They're less than a year or they're immaterial. So the term is usually pretty short for software. It's going to be 2, 3, maybe 5 years at the most. So a lot of it's immaterial, so it wasn't recorded. So I think the initial implementation, you had a lot of software licenses that you listed out, but you probably only recorded a handful of them. And they're all relatively recent too. You're not dealing with leases where you may go back, 30, 40 years looking for leases. So it was a little bit different implementation from 87. So define a subscription-based information technology arrangement. And a lot of this is just going to be deja vu. As Yogi Berra would say, it's deja vu all over again. But you're going to create an intangible asset, right to use subscription asset, and also create a subscription liability. So it's going to be very similar to 87. includes capitalization criteria for outlays other than subscription payments. And that's going to be similar to GASB Statement 51 that Nick went over, and then requires note disclosures, similar to 87 as well. So the SPID is a contract that conveys the control of the right to use another party's IT software. So it can be a loan, or it could be with a tangible capital asset, similar to basically hardware. And it's, again, an exchange or exchange-like transaction, so you have to be exchanging similar values. So right to use, again, similar to 87, you're going to obtain the present service capacity from the use of the underlying asset, and you can determine the nature and manner of the use. A couple of exclusions on these, this next to last point. Anything related to IT support services or maintenance would be excluded. One thing I'll point out too here, and there was some confusion about this during the implementation, but any subscription that you have where you're basically paying for the actual content or information, kind of like a subscription to Bloomberg's or maybe newspaper or magazine, where you're paying for the content. There may be software that you use to access that content, but you're really paying for that content. That would not be included as a SPIDA. And then the SPIDA contracts could include various components. So there could be the SPIDA right to use, but it also could include support services components. You want to, whenever possible, to break those out, those two different components, and account for them appropriately. So here's a few items that are scoped out of GASB Statement 96. The first one is when you may have IT software plus a tangible capital asset that meets the definition of 87, where the software is basically insignificant. So the example that everyone uses for this would be if you lease laptops. So you have the laptop, there is an operating system, maybe some other software that's loaded onto the laptop, but you're paying for the laptop hardware itself, not the software. So in that instance, it would be accounted for under GASB Statement 87. The second point basically says that there's no lessor component to GASB 96. So if a government has their own software and they're providing the right to use that software to another entity, they don't have to record that as on the lessor side at all. Third bullet point is anything that's covered under P3s for Statement 94 would be scoped out. And then any licensing agreements that have a perpetual license would be scoped out as well. So that's going to be covered under Statement 51 that Nick covered. And one thing I'll point out too, any automatic renewals are not considered perpetual licenses. So anything that would automatically renew unless either party decides to cancel, that's not considered perpetual. And that was in the implementation guide question S80.701-1. So the subscription terms, is a period during which the government has a non-cancelable right to use the underlying IT assets. And this shows you basically if you have an option to extend and it's reasonably certain you're going to, you would include it. If there's a period where there's a termination, but it's not going to be exercised, and then same way on this vendor side, if it's reasonably certain that they're going to exercise it, you would include it. If there's a termination clause that they're reasonably certain not going to exercise it, then you would include that as well. So the point I'll make on this one is the term reasonably certain is basically a pretty high bar. So you're talking like it's 90% certain that you're going to exercise or not exercise these options, as the case may be. So very high. If it's below 90%, you don't want to include those periods. So short-term SPIDs are going to be anything that at the commencement of the subscription term has a maximum possible term of 12 months or less, including any options to extend regardless of the probability of it being exercised. So periods in which both the government and the vendor have the option to terminate without permission from the other party, so basically without cause, or if both parties have to agree to extend it, they're considered cancelable periods and should be excluded from the possible term. So it has to be without cause, though, for both of the parties. So if it's only because a party defaults on terms for some reason, they don't make payments, whatever, that's not considered without cause. And then any, if you want to go back slide, Nick. For that second bullet point, anything that has a rolling month to month or year to year, the maximum possible term is going to be the non-cancelable period, including any notice periods. The thing I'll point out here is the notice period. So they may say that either party can cancel with 60 days notice. Well, that would be short term. But if it is a longer term notice period, so it could be 2 years, if that were the case, then you would record a SPIDer for that 2-year notice period. And then short-term SPIDs are recognized basically as an outflow in the period that they're incurred. So recognition, measurement, accrual basis, economic resources. You're going to recognize the subscription liability and the right to use asset at the commencement of the term. So not when you necessarily enter into the agreement, but when it actually commences. It's measured as the present value of the payments expected to be made. And then they should include, and this is similar to leases again, it's fixed payments plus certain variable payments, incentive receivables, and then any other payments that might have been made. And then you discount the liability based on the interest rate that the vendor is charging to the government. So it's going to be the initial measurement of the liability for the asset, plus any payments made to the vendor, and then also any initial implementation costs that we'll talk about in a second. So it's going to be amortized in a systematic and rational manner. Yep, so amortized in a systematic and rational manner over the shorter of the subscription term or the useful life of the asset. I won't go over this too close because we are kind of running up on time, but this is very similar to GASB 51. So basically, the only thing you're going to capitalize are going to be that application development stage costs, preliminary and operating and additional implementation. You're not going to capitalize any of those amounts. And then for financial statements prepared using the current financial resources measurement focus, you're going to record an expenditure and then another financing source for in the period that the subscription base is initially recognized or when it commences. So an equal amount expenditure and then other financing source. And then subsequent payments, you're going to treat it just like debt service payments. So you're going to have principal expenditure and an interest expenditure. And then disclosures, pretty similar to 87 as well. General description of the basis, the terms and conditions, the total amount of subscription assets and related accumulated amortization. That can be included just in your basic capital asset footnote. Any outflows that related to variable payments you would disclose. And then principal and interest, that last bullet point, principal and interest to maturity for 5 years and then in 5-year increments, that can be included just in your regular long-term debt footnote. All right, GASB 104, as the title basically relates to, this is a disclosure only statement, so that's all you have to deal with. It's going to be effective for June 30th, 2026 and later. And it basically, because of all the changes in capital assets related to 87, 94, and 96, they just wanted to clarify and give some further guidance on how you're going to disclose these amounts. And then just for fun, they added capital assets held for sale disclosure as well. That's new. So we'll take a look at that. So basically, you're going to show separate disclosures for GASB 87 leased assets by major class of asset. GASB 94 on the operator side, not the transfer side, but the operator side, you're going to show that by major class of asset as well. And then GASB 96, you're going to show subscription assets separately. And then any intangible assets not otherwise considered, like internally generated software that Nick talked about, or permanent easements, they would be also shown by major class of asset.
Hey, Jim and Nick, just for the sake of time, could we launch the final poll so we can make sure everyone gets their CPE before we wrap?
Absolutely.
All right, so I'm going to launch that poll right now. So how many software subscriptions applied within your organization are related to GASB 96? So again, for CPE credit, you'll need to reply to this. Right now, it looks like 1 to 5 again. All right, I will close the poll. And with 45%, we have 1 to 5.
And I will try to get through the rest of the slides in 3 minutes. So here's an example of a capital asset disclosure. You can see the intangible assets are shown separately, subscription assets for 96, and then leased assets for equipment under 87. And you can see there's just one total for capital assets being depreciated and total accumulated depreciation. Don't need to separate them by tangible and intangible assets. Capital assets held for resale under 104. So it's held for sale if the government has decided to pursue the sale of the asset, and it's probable that the sale will be finalized within 1 year. So probable is somewhere between more likely than not, which is greater than 50%, and reasonably certain, like we talked about, which is like 90%. So you're talking, 2 and 3, 3 and 4 chance that it's going to be sold. And you want to reassess that held for sale criteria each year. And then continue to report the asset held for sale in the appropriate major asset class on the roll forward. So that doesn't change at all. You just have a separate disclosure regarding the historical cost and accumulated depreciation for those assets that are held for sale. Separately disclose if those assets are pledged for any debt, and then break it out by governmental activities and business type activities. And here's an example that's straight out of GASB 104. So it basically says that it's a building that's held for sale in governmental activities, $8 million in cost, $5 million in accumulated depreciation, and it's pledged as collateral for debt with a balance of $1.5 million. And last part we're going to do here real quick is go through the basically the financial statement presentation. So for the government-wide statement of net position, you're going to show, in this example is from City of Elgin, who implemented GASB 104, I'll say right off the bat, but the statement of net position, you'll see here capital assets not being depreciated, about 2/3 of the way down the page, and then capital assets being depreciated. So those amounts are split out separately. And then on the next slide, you'll see the net assets for governmental activities and business type activities. The net investment in capital assets is basically capital assets less any debt that was used to acquire or construct those assets. You also want to include any capital related accounts payable and retainage payable at the end of the year. That's been a point of emphasis with anyone who participates in the GFOA certificate program. And then also don't include any debt that did not create an asset. That can also be something that trips people up. On the statement of activities, depreciation and amortization, that's not shown separately. It's allocated to each function or program. And then therefore you've got to be able to track that in your system separately. And I just show the first page of the statement of activities here for City of Elgin. You'll see the expenses listed out. You'll see no depreciation. It's all by function. But in the notes, you do have to disclose how that depreciation is allocated by function. And we'll see that in a second. The summary of significant accounting policies, Nick's kind of gone through these things, but the policy for capitalizing assets in the thresholds, estimating the useful life, and the method used to calculate depreciation, which is usually always straight line. And you'll see an example here again from City of Elgin, useful life greater than 1 year and thresholds by major asset type. So they don't have one, they've got several different thresholds based on what type of asset it is. And then you can see the straight line depreciation over those estimated useful lives. And then the detailed note disclosures, you're going to have your basic roll forward, beginning balances, any acquisitions, sales, transfers, and then an ending balance broken out by governmental and business type activities, and then separate capital assets. I missed that last bullet point, but and like I said, yeah, separate depreciable assets from non-depreciable assets. And then depreciation expense, show it, like I said, by function. And I've got an example of this too. So this is City of Elgin. You'll see the leased assets are shown separately by asset type. Then there's subscription assets. And then the same thing in the accumulated depreciation section as well. And you can see the standard roll forward, beginning balances, increases, decreases, ending balance. And this is how the depreciation was allocated by function in governmental activities. And we made it. And only 2 minutes over.
Not too bad.
Yeah. So yeah, I want to thank everyone for their participation today. Really do appreciate it. Our next session is going to be on November 19th. Related to Financial Data Transparency Act. That'll be our session number 11. And if there's any questions that we didn't get to or that you have later on, we'd be happy to answer those questions after this presentation.
Awesome. Thank you.